Okay, thank you very much for having me. I wish I could have come for real, but at least we get the chance to exchange this new way. So this paper is called Optimal Monetary Policy according to Hank. So for some of you who are familiar with this trend of the literature, or who have heard of this trend of the literature, there is this paper by Kaplan, Moll, and Violante, who's called Monetary Policy According to Hank. And what they do is that they explore the transmission mechanism of monetary policy in a setting with heterogeneous agents and where prices are rigid, so that monetary policy has a bite. So we're extending that naturally to the question of optimal monetary policy. Okay, so I should say this is joint work with Sushant Acharya and Keshav Dogra, who are at central banks, and therefore the usual disclaimer applies. So really, the question that we are asking is the following: in an economy where households are regularly hit by idiosyncratic shocks that are uninsurable, so that it generates ultimately potentially large inequalities across agents, how does that feature modify the way in which the central bank should respond to aggregate shock? Okay, so we're interested in the normative question, not only the positive question of the effect of monetary policy under heterogeneous agents. Now, you could think that it's a reasonably simple answer. I mean, we all know or have some familiarity, at least, with optimal monetary policy in a very simple setting, say the three-equation model in Galli. And many researchers have extended that framework to introduce additional frictions, so frictions in the labor market, frictions in the capital market, various frictions. So the lessons that we had drawn from the simple model, we are now able to see whether it applies to a more general settings and whether other frictions change the basic lessons of the model. So you could have thought that it's been done also for incomplete markets. Well, it turns out that it has not been the case until very recently, at least. And the reason for this is that taking into account incomplete markets raises the complexity of the problem by several order of magnitudes relative to considering other frictions. Okay? And the problem here is that when you solve an optimal policy problem with heterogeneous agents and initial idiosyncratic risk, you're basically solving an infinite dimensional fixed point problem. Okay, and the issue is the following: to solve the optimal policy problem, you need a social welfare function that aggregates the intertemporal utilities of all the agents. Okay, but those intertemporal utilities are all endogenous to the policy path. Okay, so this fixed point problem is relatively straightforward under the assumption of a representative agent, whatever the other frictions that you are putting in, but it becomes highly untractable under incomplete markets. So some numerical methods are currently being developed to tackle this challenge. We're taking a completely different route. We're trying to solve this fixed point in closed form, essentially. Okay, so we're going to use an incomplete market model that admits, for the reason that I will be more explicit about, that admits, that allows to be at least partly solved in closed form. So we're going to use a Cara normal Hank model. So Cara stands for constant absolute risk aversion. So the utility function, those will have constant absolute risk aversion, and idiosyncratic risk will be normally distributed. Okay. Because this joint assumption will generate linear policy rules. So we're going to have closed form solution for the aggregate dynamics of the model, and when we do that, we're not really improving on what other researchers have done before. It's known that you can aggregate decisions or linear decision rules under those assumptions. where we are pushing these frameworks is in two dimensions. We can explicitly, under our assumptions, compute the distribution of agents and its law of motion over time. Okay, so we do have a closed form expression for the cross-sectional distribution and for the dynamics and for the law of motion of the dynamics of the distribution of agents. And we're going to use that to analytically compute the social welfare function. Okay, so now the fixed point problem, which required aggregating infinitely many intertemporal utilities, will be tractable thanks to this aggregate social welfare function. Okay, once we have a closed form, the social welfare function in closed form, we can solve an optimal policy problem using reasonably standard tools such as those used to solve models with a representative agents. Okay, so let me give you the main results that we have before I go into the details of the model. We're going to find that optimal monetary policy is essentially governed by two forces. One force is price stability. It's not very surprising. Price stability comes from the fact that there are costs to price dispersion for the usual reason. We're going to work in an economy with Calvo pricing, and Calvo pricing implies that price dispersion, departure from zero inflation, generates cross-sectional dispersion, which is costly, which is a source of welfare loss. So there will be this motive of price stability. But this can potentially clash with another motive, which is that the planner under heterogeneous agents wants to stabilize consumption dispersion. Okay, consumption dispersion is going to be costly to a utilitarian planner who doesn't like that dispersion between high marginality and low marginality agents. Okay, and what we stress here is that consumption dispersion is not only affected by the cyclicality, the income risk that agents face and the potential cyclicality of this income risk, it's also affected by the path-through from income risk to consumption risk. Okay, people do not directly derive utility from income, they derive utility from consumption, and between income and consumption there are decisions, and in particular there are savings decisions. Okay, so monetary policy, as I will be more explicit about that, monetary policy does what it usually does in the new Keynesian model, but it also affects directly or indirectly the income risk that agents face, and also the path through from the income risk to the consumption risk that agents face. Okay, so that's going to be additional margins that the central bank has to affect the amount of consumption dispersion, which is what it wants to do in addition to stabilizing prices. Okay, and the main result, I'm going to show you how, but basically these two objectives may conflict. And in that case, the central bank may want to depart from strict price stability or zero inflation to reduce consumption dispersion, perhaps because fully stabilizing prices would involve too much consumption dispersion. Okay, so there will be a breakdown of the so-called divine coincidence in a world where the divine coincidence results, meaning the desirability of absolute price stability, divine coincidence would hold in a rank version of the model where basically the second motive is killed. Okay, so that's the key part, and I'm going to tell you more about the directions in which this is tilting optimal policy relative to rank. So if you're okay with that, I'm going to skip the literature and come back to it at the very end of the talk, and I'll jump straight into the description of the model. So we're gonna have
Hi.
Yeah.
One question: when you are talking about the optimal monetary policy, like having a role in reducing consumption dispersion, that is abstracting for any active fiscal rule? Because one might think that, I mean, the monetary policy has one objective, but this consumption dispersion sounds more like the fiscal role that
So
maybe
that's going to be,
if they do that, the central bank could keep having zero inflation in the optimal if they have health or active tax scheme that here I guess your only margin is the interest rate, right?
So there will be some stylized, some very simple fiscal policy in the model. The short answer is that our maintained assumption is that you could have fiscal policy, but unless fiscal policy eliminates completely the effect of idiosyncratic risk, which we think is not realistic and which is not what you observe in practice, in reality, unless idiosyncratic risk is eliminated by fiscal policy, say by a complete set of means-tested transfer, there will be some residual inequalities, and we are solving for optimal policy under the source of inequality. Okay, so this is not inconsistent with monetary policy playing a role. This is inconsistent with fiscal policy eliminating every source of inequality. Okay, which we do not observe.
Okay, I mean, I just was wondering how much are you deviating by kind of like the dogma that you should have one instrument per one objective, and here you can like having.
So there are different questions to your question. One question is, maybe you want to have an aggregate fiscal tool that could be time varying, and that is a complicated issue that we are not dealing with here. But basically, the bottom line is that it's related to what I was saying before. Actually, what you're saying, when you have any friction other than incomplete markets, the assignment problem that you were hinting at applies. You want as many instruments as you have frictions, and maybe a sufficiently rich fiscal policy would eliminate that. But when you have incomplete markets, it's as if you would need infinite fiscal instruments, right? Because they are the source of inequality is infinite dimensional. Okay, so you would really literally need a complete set of means-tested social programs, say. Okay, if you do not have that, you're going to have some inequalities, and the central bank is going to have to take care of it. Okay.
Thank you.
Sorry, can I add something there?
Yeah, sure.
So, but at the end, this is a quantitative exercise, right? So no, okay.
It's not. No, it's not. So we're I'll be completely clear and honest about that. It's not a quantitative paper. It's a theoretical paper. We aim to clarify the channels of monetary transmission in Hank and how that fits back to optimal monetary policy and change so basically we aim at doing exactly what Clarida Galli-Gertler did some 20 years ago in the case of the three-equation model, devising simple, very simple rules, simple targeting rules for monetary policy in the simple scenario without any frictions aside from monetary policy. We want to do that for the Hank model. Okay, so we're going to use a very stylized model to see how those targeting rules are modified by inequalities.
Okay, so at the end, the calibration of the income process and all of that stuff will not influence the results.
No. I mean, it would quantitatively, but we're trying to draw qualitative lessons, essentially. We have a size 1 population of agents with a Blanchard-Harry demographic, so people die with some probability in every period, but the total mass of the population remains equal to 1. Okay, so that guarantees that the cross-sectional distribution of wealth remains well-defined and stationary, asymptotically at least. People maximize this. So this is the problem of a household born at time S. So we refer to S as the cohort and time as and T as time. So a cohort is born at a particular time S, and then will live at S plus 1, and so on. And people within every cohort So people are heterogeneous potentially across cohort, and within every cohort, they will be hit by shocks that are going to cause them to depart from each other within the same cohort. Okay. So this is the U of C, psi minus L is the utility functional. C S of T is the consumption of I. CST of I is the consumption of agent I belonging to cohort S at time T. Psi ST is an exogenous time endowment, which is going to be stochastic and idiosyncratic. And LST is the labor supply of this agent. Okay, so agents are subject to this idiosyncratic shock, and they're going to adjust their labor supply and their consumption demand in response to those shocks. The constraints that agents face are below. So we have here consumption, bond purchases. So QT is the nominal price of a bond. The real price of a bond. AST plus 1 is the quantity of bonds purchased by the agent. This is labor income. This is past asset accumulation, and this is a transfer. And we assume that people start with zero wealth initially. Okay. And very importantly here, we're going to assume that psi is normally distributed. Okay. Part of the reason why we get a closed form solution is that we combine normally distributed idiosyncratic risk with this constant absolute risk aversion utility functional. Okay. So it's going to be negative exponential in consumption and negative exponential in leisure. Okay. The difference between the time endowment and labor supply. Is that clear so far? If there is no question, I will proceed. So this is for the behavior of the household. Before I turn to the analysis of the equilibrium, I just want to sketch briefly what is the behavior of firms. There is nothing new here. So I'm just stating the equations characterizing the behavior of the firm just for reference. We have the standard New Keynesian supply block here. Okay, so we have a competitive final good firms that aggregates the goods produced by monopolistically competitive wholesale firms, and those wholesale firms face nominal frictions, and we assume Rothenberg pricing frictions for simplicity. So the cost of price change, contrary to what I've said before, the cost of price changes comes from the fact that you have to incur this Rothenberg cost. It doesn't come from price dispersion. And as we know, this generates the New Keynesian Phillips curve, which is here in nonlinear form, where inflation, current inflation depends on future inflation. So big pi here is the inflation factor, and it depends on the real marginal cost. So here there is no capital. So the real marginal cost is the real wage, WT, divided by labor productivity Z, okay? And the higher real marginal cost is basically pushing inflation up, urging firms to raise their prices. ZT it's the only shock that I'm going to be considering in that presentation. We are now generalizing the framework to accommodate more shocks. It's going to be a one-off aggregate productivity shock occurring at date zero. So it's going to be an economy without aggregate risk, essentially. There is an MIT shock at date zero, and that shock actually gradually reverts towards steady state over time. Okay, but in the process, there will be a lot of idiosyncratic shocks. Tau is a constant payroll subsidy. It plays the same role as in the standard optimal monetary policy analysis in the three equation New Keynesian model. It basically undistorts monopolistic distortions. Okay, so it's also do something else in our framework, and I'll go back to this later on. But we don't need to go into the details right now. But it's fairly standard in that class of model to posit the subsidy. Of course, we could study also the equilibrium without, but it makes the whole analysis more streamlined. And YT here, which also shows up in the New Keynesian-Phillips curve, is net output or net income, which is the same thing here. ZTNT is gross income, is gross output, what you produce out of having n unit of labor as input in the economy. So ZTNT is the gross output, but you need to remove the inflation cost that comes from the rent-over cost of changing prices. And when you factorize, you get this expression here. Okay, so there will be a gap potentially between gross and net output coming from those changes in inflation, and that is what makes inflation costly here. There are financial intermediaries that basically hold the nominal bonds and also trade the real bonds with the households. The reason we assume this is that we need those actuarial bonds, as is often the case in the Blanchard-Chiari type of model. There are potentially here two sources of idiosyncratic risk. One is the risk on the labor endowment that I mentioned, but there is also a death risk, okay, because people die with a constant probability. And we are assuming essentially that this death risk is completely diversified through the trade of these actuarial bonds. Okay, so that means that the return that you get on a real bond when you trade one as a household, if you're a creditor, you're going to get a return that is slightly higher than the interest rate than R, R being defined as the ratio of the policy rate plus 1 over the inflation rate, the usual real rate. But here you're going to get a return that is slightly higher, but your wealth will be seized upon death. And the other way around, if you're a debtor, you're going to be paying a slightly higher interest rate on your debt, but your debt is forgiven when you die. Okay, this is the standard assumption people make when using the Blanchard-Chiari model, and we're not departing here. And below is the budget constraint of the government budget constraint. We have three market clearing conditions, so we're going to assume that the quantity of nominal bonds is zero. So there will be real bonds in the model because agents will be lending to towards each other. We're going to have heterogeneous agents, zero net asset supply, but trades of assets between the agents. Okay, and that is those trades that are going to generate dispersion of wealth among the agents. Okay. And for the rest, we have the usual market clearing conditions. So here you can observe that I'm aggregating within generations. And also, so this is consumption, which I'm aggregating within generations and across cohorts. Okay. So cohorts, because there is some probability of death, cohorts gradually shrink in size. Okay, there are fewer and fewer people within each cohort. But eventually the consumption of everyone within and across cohort has to be equal to net income Y. Okay, and you can make the same reasoning for labor. This is total labor supply within and across cohorts that has to be equal to the total labor input used by firms, big small nt. And because bonds are in zero net supply, the bond market must clear at zero. But unlike in the representative agent model, this is consistent with individual agents having large positions because some of them will lend to each other. So there will be borrowers and lenders in this economy. Is that clear? If yes, let me continue.
Yes,
so here, yeah.
Sorry, excuse me. Sorry, can I ask one question about this part?
Sure.
It's a bit unclear to me since you said earlier that through the banking system, essentially you kill this sort of idiosyncratic risk in the economy, and when you aggregate the level of bonds, it's zero. So I don't quite understand why there is a need to move to a Blanchard-Chiari environment to begin with.
No, I'm not killing any heterogeneity. So basically, maybe I wasn't clear. what these financial intermediaries are availed. They don't serve any purpose because there is no friction, there is no financial friction. But there are those who trade the nominal bonds that then I assume to be in zero net supply. But in principle, there are nominal bonds that are issued by the government and that the central bank trades for interest rate setting. Okay, so they have those on their assets, and those intermediaries also trade with the agents. Okay, and they trade with the agents the actuarial bonds, which are real bonds. Okay, and then I'm letting the nominal bond supply go to zero. So I'm considering a cashless model with zero net supply of bonds, okay, of nominal bonds. But nevertheless, there will be a lot of trading between the agents. So suppose suppose you and I are similar, but then at some point we are hit by different shocks. You're lucky, you have a good endowment shocks. I am unlucky. So I'm going to borrow to smooth the shock, and you're going to lend because you want to save part of that extra income. So we're going to extend credit towards each other. Okay, so idiosyncratic shocks still generate dispersion in wealth through this effect, the borrowing and lending between the agents. Okay, so there is no insurance basically between against idiosyncratic shocks, or it's imperfectly insured. Okay, so that's where the heterogeneity between the agents come from. Is that clear?
Yes, thank you.
To solve the model, we're going to make use of a property that we did not discover, which is the linear, the Cara normal model generates linear policy rule. So there is a long history in finance, and also some papers have used that in macro. That make this Dorth assumption, and you basically generate linear policy rule, provided that you define the individual state variables suitably. Okay, so here the consumption rule, which I've written here. So this is the consumption. The first equation here is the consumption at time t of an agent whose individual state is x. Okay. So it's going to be average consumption, which is the same thing as aggregate income here, plus the effect of that individual state, which is going to be, and x will be different across agents. Okay. The relevant individual state here is what we call demeaned cash on hand. So it's going to be this term here. A is the accumulated assets of the agents, which reflects the effect of past idiosyncratic shocks, having led to more or less asset accumulation. And this term here reflects the effect of the current labor income shock psi. Okay? So if people have been lucky in the past or unlucky in the present, they will have a high X and therefore a high CT. Over time, people will be hit by repeated idiosyncratic shocks, so their X's will depart from each other, and therefore the consumption levels of the various agents will diverge gradually.
Can I ask a question here?
Of course.
You usually, I may be misunderstanding something. Usually, you consume out of stock variables, and that is a stock here, and Y is a flow. But then you take your stock X and multiply by mu, and this is fine. But then suddenly there is a wage. I would expect like life cycle income here if you could Blanchard theory consumers rather than just wage. Or I assume just A inside.
This is just a policy rule as a function of the individual state. So you would have that, you know, in a simpler model, you would just consume, say, take the permanent income behavior of an individual agent. The individual state variable would be total wealth, and a fraction of that would be consumed. Okay, this is the same thing.
That's right.
And in the individual state variable, you have both a stock, which is the wealth of the agents or the liquidity sometimes, and the effect of the current income. You have both stocks and flows in the individual state.
No, but you have propensity to consume mu out of stock, and that makes it flow. And that makes it flow.
Yeah.
But then you will multiply mu by W, but W is already a flow. So I would expect to see here life cycle income, which will be an integral of W. I'm just simply saying if your algebra works, it's kind of fine, but I would play with a different rule, where I would only have a clear distinction between stock and flows. Okay.
So basically, to maybe one way to answer your question is, why is it that this is the relevant flow variables that enters the individual state? This takes into account of the labor supply adjustment of the agent. Okay, so agents are subject to a shock. So if you had an endowment economy, the stock will be your individual wealth and the flow would just be the endowment. Here it's labor income, and labor income is itself an endogenous variable, okay? Because you adjust labor supply, okay? And that's why WT shows up here, okay? WT shows up because it's something that will determine your labor supply adjustment, okay? So this determines your individual state variable, and then you're going to consume a fraction of that. So mu t is the marginal propensity to consume, okay? So in that sense, it's the same as in a standard single agent problem or representative agent problem. So mu t here is the marginal propensity to consume out of this individual state, out of cash on hand. Okay, so if I'm given $1 more, that's going to build up on the right-hand side here. So it's going to increase X, and it's going to increase my consumption by mu t. Okay. And the MPC here is, we show that in the paper, is a forward-looking variable. Why is it forward-looking? Well, because it's going to be affected by your ability to use, inter alia, the credit market for self-insurance. Okay, I took the example earlier on of an agent who's hit by a bad shock and an agent who's hit by a good shock. So the guy who's hit by a bad shock is going to want to borrow to buffer the effect of the shock, and how much he will be able to do that will affect the path-through from the income shock to consumption. So that will show up in mu. Okay, but the ability to use the credit market is forward-looking. It's how you are able to borrow, how much you are able to borrow now, or how much your asset returns will be from now to tomorrow, from the day after to the day after, and so on. So it's a forward-looking variable. I'll go back to this in a minute. Leisure here is equally follows a linear policy rule. So okay, it's a linear function of X. So the difference between the time endowment and labor supply. Okay, so there will be a common component here, which is average leisure, and an individual specific component due to the dispersion in the individual state. So what would happen under complete markets in this economy if those labor endowment shocks were completely insured? Well, in that case, under complete markets, both consumption and leisure would be unresponsive to the shock. So a planner essentially what the optimal thing to do would be to say, okay, those who have a higher time endowment shock work more, and that's it. But we eliminate all the consequences of those time endowment shocks. So we equalize leisure and consumption across agents. Okay? This would be what the planner would want, and this would be what you would decentralize with a complete set of ROW securities. With the complete market, it doesn't work that way. Consumption responds to the shock in the way I've just shown, and leisure also responds to the shock, which another way of putting it is that there is insurance through labor supply. So if you're hit by a bad shock, there are two things. So you're going to consume less, but you want to limit the fall in consumption. So what you can do is to work more. So you're going to consume less leisure and supply more labor. Okay. So now I've given you the basic two ingredients that agents the two things that agents can do to buffer the shock. They can adjust labor supply, and they can use the credit market. Okay, so these two markets, the credit market and the labor market, will be used for self-insurance under incomplete markets. Okay, and the ability of the agents to use those markets to buffer the shock is completely summarized in mu, in this marginal propensity to consume. So mu t is, so to say, the sufficient statistics for the ability of agents to self-insure. Okay. So if I iterate, I had showed you before the expression for mu t. If I iterate this expression forward, I can see that mu t is determined by the course of real interest rate going forwards and the course of wage rates going forward. Okay, so here it's to the power of -1. So that means that the larger the sequence of real wage, the smaller the MPC. That's not very surprising. It means that when wages are higher, it's easier to use the labor market for self-insurance. Therefore, you're going to be more able to buffer the shock. Mu t will be smaller. And now if you look at the credit market, well, the lower interest rate, the easier it is to use the credit market to buffer the shock. Okay, think of an agent who's hit by a bad idiosyncratic shock. He's going to want to borrow to limit the incident of the shock, and borrowing will be made easier if interest rates are low. Okay, so agents use both margins to self-insure. This is reflected in mu, and this is going to be key in our analysis because I'm going to show you that one of the margins by which monetary policy affects inequality is by affecting the ease with which agents can self-insure. So we're not talking about an economy where monetary or fiscal policy would directly insure agents. We're talking of an economy where monetary policy can indirectly insure agents by making it more or less easy for them to self-insure. So any policy path will imply that there is a sequence of real interest rate and a sequence of real wage, and therefore will affect mu t. Okay? Is that clear? Okay, let me move on and complete the solution of the model. We have negative exponential utility of consumption. So the individual Euler equation takes this form, which is fairly simple. The theta cancel out because the probability that you have of dying is compensated exactly by the higher return on assets that you get. That's the purpose of actuarial bonds. I can take logs. And I obtain this log individual Euler equation, and the variance here is so this is the when I take the log of this, I use the formula for normally distributed variable, and what shows up is the conditional variance of consumption of the agent, meaning consumption risk, what we call consumption risk. Okay, and what this expression is telling you is that in addition to responding to changes in the interest rate through the usual intertemporal substitution channel, here agents respond to consumption risk. So they want to consume less if they anticipate more consumption risk. So this is precautionary savings. Okay, so here individual consumption demand will depend on the extent of the precautionary saving motive, which is captured by the last term. Now, one nice thing about this individual Euler equation is that it's linear. So you can aggregate it across agents. You can aggregate it within a generation and across generations using the market clearing condition that I've used earlier. So the aggregate counterpart, if you use both the market clearing condition and policy function for consumption, you get to that aggregate Euler equation, which is essentially the same thing as before, but instead of individual consumption, you have total consumption, which is output. Okay? So this looks like a standard IS curve of the new Keynesian model, where aggregate demand is forward-looking. It depends on future output, except that you have this precautionary saving motives here, which is tied to which is basically due to the conditional consumption variance of the agents, and which is summarized by this term. Okay, let me just explain you the terms that are here, because it's important for the rest of the analysis. Sigma square t plus 1 is the variance of the idiosyncratic shock. Okay, but the idiosyncratic shock is a time endowment shock. So how does it translate in earnings shocks? Well, you have to multiply it by the real wage, and see, because it's a variance, we have a square that shows up here. Okay, so WT plus 1 square, sigma t plus 1 square is the variance of earnings, the conditional variance of earnings. And as I said before, people do not derive utility from earnings, but from consuming some of those earnings. So you need to take into account the pass-through from earnings risk to consumption risk. And this is done by the MPC. Again, squared, because we have a variance. Okay? So you can see here that already monetary policy will make decisions that will affect WT plus 1 directly, but also mu t plus 1, because it will affect all equilibrium variables. And that's going to affect aggregate demand through this precautionary saving channel. Okay? So now, what does the equilibrium look like? Yeah.
Edouard, this is Ernesto. Very quick question, just to know where we're heading to. So in the standard Kaplan-Moll-Violante paper, the aggregate effect of monetary policy is about the same than the representative agent model, but the mechanism is different. Is that something that's going to hold here too?
So yes and no. So to be precise, what they show is that when you make markets more incomplete, you have the direct and the indirect effect of monetary policies that change, but in an offsetting manner. What is key in their analysis is how close people are to the borrowing constraints. Okay, so there is a substantial fraction of the agents who are close to the borrowing constraints. Those guys do not react too much to the direct effect of the interest rate change, but they're going to react a lot to the indirect effect due to the Keynesian multiplier effect. Okay, we don't have that in the model. Here, we do not have a borrowing constraint. Okay, so people at the individual level, they are permanent income consumers. Nevertheless, there is an MPC out of the individual shock. Okay, so people form precautionary savings, not in the sense of Kaplan-Moll and Violante, meaning against future binding borrowing constraints, but because future consumption is volatile, because they are permanent, everyone is a permanent income consumer, and every shock is moving permanently consumption. Okay, so the channel is different. So this shows up in our model in the fact that there is a unique MPC. Okay, in Kaplan-Moll and Violante, you have a distribution of MPC. We have just one MPC, mu t, but it's going to be time varying. And in a sense, our point is to say, even if you have MPC homogeneity, not heterogeneity, it still matters a lot because it's going to be moving over time and respond to policy. Okay.
I was just asking whether, sorry, just one quick thing. I was just asking exactly because of these two offsetting effects. My way of understanding is that monetary policy affects interest rates so affect people consumption, but also affect income, and that also affect people consumption. And these two things, if you shut down the income part, and if you put it together, the aggregate effect is going to be about the same. Here, even if the way to get there is different, it's still true that you have the interest rate, which is muted relative to the representative agents, but also you have the income effect now that kicks in. It's still true that these two things are going.
It's difficult to we don't have the strong indirect effects that Kaplan-Mollante have, you know, because people are because there is no borrowing constraint. People are at the individual level. People are permanent income consumers, so we do not have those Keynesian strongly Keynesian behavior in the model. However, people do respond to idiosyncratic risk because of the precautionary motive. But this is not because they are close to the this is not related to any form of hand-to-mouth behavior.
So in short, here the aggregate effect of monetary policy is muted related to a representative agent or related to the complete markets.
That I cannot answer your question straight away. You need further assumption. You need to specify how the amount of idiosyncratic risk depends on output, for example. Okay, so it could be that monetary policy by its action affects output that's going to feed back to idiosyncratic risk, and that may raise the precautionary motive or lower the precautionary motive. So I cannot answer your question now. You have to wait a couple of slides.
Okay.
Okay.
Maybe you can answer my question, because it's related to once you start introducing the marginal propensity to consume. That is a standard feature of Blanchard-Yarry. But the Blanchard-Yarry has nothing to do with income risk. So then it raises the question, how much of this mu comes from Blanchard-Yarry and how much of it comes from not Blanchard-Yarry? And more general question, what is the role of Blanchard-Yarry consumers? Why you needed them in this model? How much they quantitatively explain your result?
Okay, so you could think of Blanchard-Yarry as so in a Blanchard-Yarry, in a pure Blanchard-Yarry version of the model without idiosyncratic risk, you would have exactly the same consumption function, but there would not be no dispersion in X. Okay, so in Blanchard-Yarry, you have exactly the same type of formula. So usually the Blanchard-Yarry model has CRRA utility. But if you were to do the same as the Blanchard-Yarry, and suppose you would have assets in positive net supply, say capital and government bonds, you would end up exactly, as you're saying, with the same consumption function, except that people would be completely symmetric, and X here would be the net supply of assets in the economy. Okay, so K plus B in Blanchard-Yarry. Okay, so that's the answer to your first question. The answer to your second question is that Blanchard-Yarry is in fact not directly essential to the point that we are making, but we need that structure to make sure that the distribution of wealth remains stationary. Remember that people are repeatedly heated by idiosyncratic shock, so they depart from each other more and more. Okay, so the cross-sectional variance of consumption within if there was just one cohort, would not be stationary. Okay, what we do is that we have agents that depart within a cohort, but the cohorts become smaller and smaller as time goes back. So the fact of the cohorts becoming smaller and smaller makes the distribution of wealth well behaved in the long run. Okay.
Yes, I guess
that's why we need. That's why we need it. If we were only interested in the dynamics of the model, we would not need it. But we need a stationary distribution of the state of X.
Yeah, but from what I remember, your mortality rate is, or survival rate is not needed. That it's very low. So people kind of it's 0.95 if I remember correctly. But in order to make the model stationary, you would need like 0.999. It would become stationary. So your numerical results might be hugely affected by that.
No. The mortality rate has to be sufficiently high. So theta has to be sufficiently low. We have a condition in the paper. So basically, intuitively, the mortality rate should be sufficiently high to offset the divergence in wealth that would prevail without mortality. Okay.
Okay. Okay.
So there is a condition. Okay. Where was I? Maybe I need to speed up a little bit. So here is the how the equilibrium looks like. So now we have to summarize, we have a standard New-Keynesian model as far as the supply block is concerned, which are this equation and this equation. We have the usual definition of the real interest rate, nothing new here. What is new, what is different from the rest, is these two equations that give you aggregate demand. And aggregate demand is determined also by the marginal propensity to consume, which is forward-looking for the reasons I've explained. But the trick here is that we have a large number of agents. We have infinitely many agents type, but aggregate demand is still summarized by those two equations. Okay, so this is where we get a lot of tractability. Now, just one word about the cyclicality of risk, because it's an important question in that literature in Hank models. The cyclicality of risk determines the cyclicality of aggregate demand. So the intuition is the following, and that's true. It was the debate was clarified by a paper by Ivan Werning in 2015 called Incomplete Markets and Aggregate Demand. So, but it has a manifestation in our model. Here, the cyclicality of risk in incomplete market economies affect aggregate demand, because if you start from the simple model where you have the aggregate Euler equation in the representative agent model, future output, holding the interest rate constant, future output will cause aggregate demand to fall 1-for-1, okay? That's what happens in the standard model. Now, what if you add idiosyncratic risk? Well, the question is, so so suppose you're expecting a recession, so you're expecting future output to go down. Do you also expect idiosyncratic risk to be higher or lower when output falls? Okay. If you expect idiosyncratic risk to be higher, say because unemployment risk is greater, then you're going to have the same effect, plus there will be the precautionary motive effect against this higher amount of idiosyncratic risk. So current demand will fall more than 1-for-1. Okay. On the contrary, if idiosyncratic risk is procyclical, so falls when there is a recession, then there will be less precautionary saving in a recession, so our current aggregate demand will fall less. Okay. So when this shows up in when we linearize our aggregate Euler equation, which determines aggregate demand. So the way we're dealing with this problem, to be very clear, we specify, so you remember that sigma t determines the cyclicality of the variance of idiosyncratic shocks. We know that in the data, there is some cyclicality in this risk, and we parameterize the cyclicality. Okay, so here, this is saying that the conditional variance of earnings depends on output as a deviation from steady state. So when you're so if phi here is the constant phi, the parameter phi here is negative, it means that idiosyncratic earnings risk is greater in a recession. And if phi is positive, it means that earnings risk is greater in a boom. Okay. So depending on the value of phi, we nest the various cases that have been studied by Werning, Bilby, and also my co-authors in a previous paper. Okay, so when you linearize the Euler equation with this specification for the cyclicality of earnings risk, you have this theta parameter that tells you how much current aggregate demand responds to future output, and it's going to be equal to 1, or less than 1, or more than 1, depending on whether risk is procyclical or countercyclical. Okay, the realistic scenario, the plausible scenario, is that idiosyncratic risk is countercyclical, so an economy is more risky in a recession, and therefore theta is higher than 1. Okay, there is a premium in the Euler equation. When you have a recession, recession have a stronger bite on aggregate demand because of the rise in the idiosyncratic risk that agents face. Okay, so let me turn to the optimal policy problem. So we need to solve, as I said, something that is a complicated fixed-point problem. Now, if I write the social welfare function, a simple utilitarian social welfare function, you already see the complexity of the problem. You need to aggregate the intertemporal utilities of the agents within every cohort, knowing that shocks are normally distributed. So you have a full support with an infinite dimensional heterogeneity within every cohort. And then you need to aggregate across cohorts those intertemporal utilities. So you have large cross-sectional heterogeneity in this economy. Okay. What we're gonna do is that, and that is new to this this paper, relative to the other frameworks that have used the Cara-normal framework, we're gonna use the Cara-normal assumption to show that you can actually considerably simplify this expression. Okay. When you play with this equation here sufficiently over sufficiently many pages, at the end you reach this expression here. So this is saying that this complicated social welfare function can actually be separated into two components. One component is the utility functional, so this is still a sum of utility flows, but in the utility flows, what do you have? One component is the utility functional evaluated at average consumption and average leisure. So it's the felicity, the flow utility of the representative agent. And it's a notional flow utility because in the general case, there is agent heterogeneity. So it's just evaluated at the average consumption, average leisure, times a new aggregate state variable, big sigma t, which is going to be a sufficient statistic that summarizes all what the planners need to care about regarding the amount of consumption inequalities. So sigma t aggregates, suitably aggregates consumption inequalities within and across generations. Okay?
Hey?
Yeah.
One question. This cost of inequality is just referring to the fact that one additional consumption item gives more equality to the poor than to the rich, or is it's also referring that the planner dislike having people with more utility than others?
The planner is utilitarian.
Okay.
So the cost of inequality to him reflects consumption dispersion across agents.
It's just
the fact that some agents have
is inefficient more than I dislike inequality. It's an inefficient allocation of consumption.
The planner doesn't. Yeah, exactly. The planner does not have a specific dislike of inequality. It's just utilitarian, and so it gives equal weight to everyone. But some agents have more marginal utility than others. Okay. So how do you see that it aggregates consumption dispersion? So the sigma c squared ts is the cross-sectional consumption dispersion, is the cross-sectional variance of consumption at time t for the cohort born at time s. Okay, so a cohort born at time s starts with the a cross-sectional variance of consumption that is sigma square c s s, and then it's going to be s plus 1s, s plus 2s. And this cross-sectional variance will be increasing over time as agents move away from each other. Okay, but that's at the level of one cohort. And you need to aggregate the cross-sectional variances across cohorts, which is what the summation does here. Okay? And this is truly equal to this term. So you remember that we have a negative exponential utility here. So if big sigma t goes up, that makes the planner less happy. Okay, so sigma t is really the cost of inequality. In the rank model, you don't have any cross-sectional consumption dispersion. So all the small sigma c's are equal to 0, and the big sigma as a result is equal to 1. Okay, so the x of those 0 is equal to 1, and the summation here sums up to 1. So big sigma t becomes equal to 1, and we are back to the felicity of the notional agent, of the notional representative agent. Under agent's heterogeneity, this big sigma t is going to be hovering above 1. Okay, in response to aggregate to fluctuations in the aggregate state, and the planner will be less happy as a result. I'll spare you the sketch of proof for lack of time, but essentially we're using the properties of we're using the fact that we can characterize, as I said before, the distribution at every point in time, the distribution of agents, so the variance within and across generations. And we can combine, so we have distributions for the individual state X, and we can, so it's going to be a sum of, it has the form of a sum of densities of normal distributions. And we can combine that with the indirect utility function of the agents, which have a negative exponential form. Okay, so we complete the square in a way that is a bit more complicated than usual, but it's basically about completing square. And when you do that, you end up with the social welfare function that I've just showed you. Now we have this new state variable written I've done in the previous slide. It's not very useful, but what we show is that it evolves recursively. Okay. So this is, you can check that if you, so sigma t is a function of this term here, which is determined at time t, the log of big sigma t, plus a function of past big sigma t. Okay, so you can check that if you take logs and you iterate, so you replace big sigma t minus 1 by its value, and you do it over and over again, you go back to this sum here. Okay, so just to summarize, this is innovation to consumption dispersion, this term here, at the level of the economy as a whole. So it's going to be a shock to this composite variable is going to increase the consumption dispersion of every generation. And that will show up in aggregate cross-sectional consumption dispersion. Okay, now this effect is going to be dying out over time because some agents are dying. So eventually the effect of the shock vanishes as new agents enter the economy. Okay, so inequality is slow moving here. A shock to inequality is persistent, but transitory. And the innovation to this aggregate state variable depend on consumption risk, not surprisingly. And consumption risk, we've seen what determines consumption risk. It's the variance of earnings risk, sigma t squared WT square, times mu t square, because it's affected by the pass-through from earnings risk to consumption risk. Okay. There is something a bit special about date 0. The recursion does not exactly apply to date 0. I'll go back to this at the end of the talk if I have time, but let me keep that part for now and focus on the stationary problem. So how are we going to solve the optimal policy problem, where now it's reasonably straightforward? We're going to maximize W0, the welfare of the agent, using, say, the nominal interest rate as an instrument, using all the equilibrium conditions, which are the optimality conditions of the private sector, and this additional constraint, which is the law of motion for cross-sectional inequalities. Okay? So the optimality condition of the planner are given by the first order condition of the Lagrangian function associated with this problem. And what is new here relative to the representative agent New Keynesian model is that there is an incentive to lower big sigma, or at least not to cause big sigma to increase too much when you do a policy steps. This is where inequalities may twist optimal monetary policy relative to rank. Maybe there are things that you would do under rank that you will not do because it would involve, say, large fluctuation in the interest rate that would be detrimental to risk and to self-insurance. So you won't do it as much, for example. There is a potential conflict here with the usual objective of price stability. How are you going to lower this big sigma t? So again, I'm going to show you only two ways, because one is related to date zero, and I want to skip date zero for lack of time. So there are actually two ways, at least, to lower sigma t. Well, if idiosyncratic risk is cyclical, you can manipulate output in a way that reduces idiosyncratic risk. Okay, so if the central bank fears the effect of unemployment risk, say, on aggregate demand, what it can do is stabilize output to limit the increase in unemployment risk. Okay, and that's going to play out in addition to the usual reason why the central bank would want to manipulate output. There is this additional channel through unemployment rates. Okay, so typically, if risk is counter-cyclical, as it is in reality, you really want to be more accommodative, all else equal, especially following a bad aggregate shock, because you really want to have this extra gain from reducing idiosyncratic risk. But the other thing that you can do, that you will do, whether or not you like it, is to affect the MUTI, the path-through from earnings risk to consumption risk. Because for the reasons I explained before, the course of interest rates and the course of wages affect the ability of agents to buffer the shocks that they are facing. Okay? All else equal, you would want as low a MUTI as possible. And that, again, will twist monetary policy decisions, in addition to the effect of earnings on earnings risk. Okay? So what I'm going to do, I'm going to look at simple targeting rules, trying to understand when optimal policy departs from the divine coincidence result, which guides optimal monetary policy in many specifications of the new Keynesian model. So let me just remind you what the targeting rules are under a representative agent. So if we shut down completely idiosyncratic shock in our model, we recover the divine coincidence result. So the optimality condition of the central bank is given by those two equations. So let me focus on the first equation, which is the stationary problem, abstracting from date zero. And YT hat star is the deviation of the efficient level of output from its steady state value. YT is the deviation of actual output from its steady state value. Pi t is inflation. Divine coincidence is saying you want that to be the whole thing to be zero, and this is consistent with having YT equal to Y star and pi t equal to 0 at every point in time. Okay, so you can achieve both objectives at once. Now,
Edouard?
the question is, yeah.
Sorry, very quick. You have a little bit more than 15 minutes.
Yeah. I have my watch just here, so I'm tracking the time as well. Now, the next question we're asking is, now we have incomplete markets. We have monetary policy that affects both the extent of idiosyncratic risk and the path-through from idiosyncratic earnings risk to consumption risk. Is there a specification of the model where we would replicate the divine coincidence result? Okay. So can a version of divine coincidence hold in Hang? And we're going to use that case as a benchmark to understand why and when we depart from divine coincidence. And the answer is yes. There is one set of parameter values where divine coincidence hold, because the effect of monetary policy on idiosyncratic risk on the one hand and on self-insurance on the other hand exactly offset each other. This occurs when risk is mildly procyclical. So suppose risk is mildly procyclical, idiosyncratic risk, so there is slightly more risk in a boom and slightly less risk in a recession, and the effects on self-insurance are the ones that I've described below. Well, then, think about it. The central bank is tempted to improve self-insurance by lowering the policy rate, by engineering a boom. Engineering a boom means lowering the real interest rate, raising real wages. Both effects will go towards reducing mu-T, the MPC. And that's good because that lowers consumption risk. So the central bank wants to do that. On the other hand, engineering a boom, if risk is procyclical, is going to raise idiosyncratic risk. It's going to raise earnings risk. And there is a case in which the two effects exactly offset each other. So in fact, the central bank doesn't want to depart at all from the divine coincidence. The two effects cancel out. Okay? In that case, we have a target criterion that really looks like the divine coincidence, except that we have this coefficient here. Under the representative agent, we would have beta r is equal to 1. Here, 1 over beta r is slightly above 1, because r is below 1 over beta, because there is just precautionary savings. But otherwise, the divine coincidence result holds. Okay, let me skip date 0. Now, consider the case where the realistic case where risk is not procyclical but countercyclical. So risk is greater in a recession. Then monetary policy, then the two forces I've referred to pull monetary policy in the same direction. Okay? So typically in that case, suppose you have a recession. Okay, the recession is costly, risk increases, so you have even more of a motive to accommodate the shock, and in addition, if you want lower policy rates, okay, because you want to improve self-insurance, so you want to limit risk, you want to improve labor market condition, and you want to improve credit market conditions. And all that pushes monetary policy in the same direction in a typical recession. So this is captured by this modified targeting rule, which is saying that you respond less to changes in the efficient level of output. Delta is below 1. So for example, if you have a productivity-driven recession, instead of completely tracking the efficient level of output, you're going to do it less, okay? Why is that? It's because tracking the efficient level of output would require, in the case of a negative technology shock, an increase in the real rate that would be too detrimental in terms of inequalities. Okay? So this is an instance in which the two objective conflicts. While the underlying shock is a productivity shock, we know that in rank, a productivity shock does not cause divine coincidence to break down, but here it does. Okay, so let me show you the impulse responses. Forget about the title of this slide, but it's basically a situation. So I'm abstracting from what's happening at date 0 again. I'm looking at an economy where the targeting rule is the one that I've just described under incomplete markets, and here I'm considering the effect of a negative aggregate productivity shock. Okay, so negative aggregate productivity shock that causes a drop in the efficient level of outputs. Okay, so what's happening here? So here in blue, in red, you have the optimal path of all variables in the rank model, the optimal policy that you would implement in rank. Well, in rank, because there is no departure from divine coincidence, you want flat inflation and a flat output gap here. This is the output gap, the welfare relevant output gap. Okay, so you equate both to 0, and that means that actual output exactly track the efficient level of output. So the red line here under the representative agent model is both actual and efficient outputs. How do you do that? Well, you do that by raising the policy rate. Why is that? Recall that it's a transitory technology shock, so people expect a recovery. People are hit by the shock today, and they expect the economy to recover. In rank, they are permanent income consumers, so they want to borrow against future income. If you don't prevent them from borrowing by raising the policy rate, this will be inflationary. Okay, so if policy did not react enough, then aggregate demand would be too high relative to supply because of permanent income behavior, and that would be inflationary. So optimal policy commands a sharp rise in the policy rate in that situation. Now, what happens in Hank? Well, you don't want this sharp rise in the policy rate for several reasons. Okay, one reason is that the direct effect of this sharp rise would be an increase in the path of the real rate that would be killing the ability of agents to use the credit market to self-insure. And you want to make self-insurance more easily. You want agents to be able to borrow substantially in a recession. Okay, so the least thing you want to do in that situation is to sharply raise the policy rate. So you want to be more accommodative. Another reason why you want to be more accommodative is that by being more accommodative, the real wage will fall, but less than if you implemented the same policy as in rank. And again, you want real wages not to fall too much, because when they fall a lot, the ability of agents to use the labor market to self-insure is reduced. Okay? And finally, in as much as idiosyncratic earnings risk itself is related to the business cycle, you want to reduce the increase in idiosyncratic risk, the direct effect of the shock on idiosyncratic risk. Okay, so concretely, you're going to raise a bit the interest rate, because some of what I said about the representative agent economy is still true. Aggregate demand is still too high relative to supply, but you're going to do it less. And therefore, you're going to let actual output to deviate from the efficient level of output upwards, and that's going to be inflationary. Okay, so you're more accommodative. There is more gradualism, if you wish. You're more accommodative in a recession, because if you were doing exactly what the rank commands, then you would screw up consumption inequalities due to the several channels that I have discussed. Okay. And you can show, so there are two effects here of the monetary policy response. There is the effect, the direct effect on earning risk, that you affect the level of earning risk by manipulating output. And there is the self-insurance channel, which is summarized by mu T. Okay. So in the red line here, you have the mu T that would prevail in a representative agent. But precisely, you want to reduce the path-through from earnings risk to consumption risk. So you don't want to to shoot up as much as it would in the representative agent. So your policy has the effect of reducing this path-through. So all else equal, of reducing consumption dispersion. Okay.
Can I ask you some quick question?
Yeah.
So when phi is equal to 0, then there is no relationship between the aggregate shock and the idiosyncratic risk, right?
Yeah, okay. Exactly.
So in that case, given that only when phi is greater than 0, if I remember well, you have the same result than in rank. Then when phi is equal to 0, you don't have the self-insurance channel. You only have
no. When phi is equal to 0, you don't have the cyclical risk channel. So earnings risk does not change, but it still remains true that for that constant level of earnings risk, policy affects self-insurance. It affects the pass-through.
But okay,
it
so
affects
how is that? Because I thought that the policy will affect self-insurance because it ensures that in the future you will have less risk, right?
No. There is earnings risk. So there is earnings risk. Earnings risk is to summarize, is WT square sigma T square.
Right.
So that is affected by the business cycle.
But
suppose phi
right?
is equal to 0. Suppose phi is equal to 0, so that WT square sigma T square is constant.
Right.
Consumption risk is that times mu T square. So it's still true that your policy will affect mu T square, will affect the path-through from that earnings risk to consumption risk. And you care about consumption risk.
Okay.
So to answer your question, even if phi is equal to 0, my figures are gonna look exactly like that.
Okay.
Because I'm in a situation where I want more accommodation because I want to make self-insurance easier.
I thought that mu depends on the future path of income risk.
No. Mu depends. So the recursion on mu, let me go back. Mu. Mu is here. So mu depends on current and future wage rates and on current and future real rates. Okay. So mu T, as I said, basically is a sufficient statistics for the self-insurance that agents enjoy. When they're hit by the bad shock, they can work more to buffer the shock, or they can borrow to buffer the shock. It's easier to do that when wages are high and interest rates are low, and the other way around.
Okay.
Okay. So even if risk is constant, monetary policy will affect mu. It will affect the equilibrium, therefore it will affect mu. And that's going to twist policy relative to rank in the same direction that as I just showed, towards more accommodation in a recession.
So is that a measure of some kind of permanent income for the agent? Something like that?
So agents are permanent income consumers at the individual level, okay, because there is no borrowing constraints. But there is this, there is this path through. So in any model, in any permanent income model, you find more or less that consumption is a multiplier of the state variable of the agent, which could be wealth. So we had this discussion a bit before. Right. In the Blanchard model, you have this also this MPC. It's a feature of permanent income behavior. It's just that it is affected by the business cycle and therefore by monetary policy.
Okay, I see. Thanks.
Yeah. Do I need to conclude, or maybe we can? I don't need to.
I would say that leave the room for questions. So if anyone wants to jump in and ask questions, please do so. I have several, so this is your last chance.
Hi, can I ask a quick question?
Sure, go ahead.
Hi, so this is Michael Boutros. So thank you for this great presentation. I was wondering about the objective function of the social planner here. In your opinion, how close is that to reality? Because there has been more discussion about inequality, but do you, for example, and your co-authors who are at central banks, think that maybe this is how the central bank is going to start thinking going forward?
So, in a way, we are currently, so there are two answers to your question. One is policy oriented, and the other one is more theoretical. Let me start with the policy question. I mean, the objectives of the central bank are not necessarily exactly the ones that we have in our models, but they do capture some of that. So many central banks would be reluctant to recognize that they care about inequality in any case, but I just don't think that's true. Even if they don't, inequality is part of life, and it's just not true that the central bank does not care about inequality. Just as it's not true that it may care. Monetary policy, central bankers face trade-off, okay, and clearly. Inequality is something that consciously or unconsciously is on the map. Now, regarding the specific social welfare function that we are positing, it's one among many possible function in the sense that it's a utilitarian social welfare function. So it aggregates the welfare of all the agents with a specific set of welfare weights. So this is something that we are now relaxing. We are working in a revision towards having a central banker that may have his own preferences towards inequalities. That may be not exactly, so that may reinforce the concavity coming from the utility function of the agents, or weaken that. But we can, there is a class of parametric social welfare weight function that allows us to keep tractability away from the pure utilitarian case. Does that answer your question?
Yeah, it does. Thank you. Very interesting work. Thank you.
Thanks.
Anyone else?
I can ask, but that's one question about what you're missing all the time when you're trying to discuss, to deliver the paper. This about your paper, actually, these 0 terms which you fiddle with by solving under commitment. My understanding was that you just derive social utility. This is fine. You derive the recursion for sigma. This is also fine. Doesn't seem to be any any problems with that. But then you start fiddling with some 0 terms for no particular reason, and that I didn't understand. Maybe you can have a quick explanation of it.
Of what? Sorry, I didn't understand your question. What is it that you objected?
I'm not objected. I want more understanding. When you derive social welfare, I'm happy with that.
Yeah.
You derive recursion for sigma.
Yeah.
I'm happy with that. So for me, this is just like a normal standard approach how we deal with, in macroeconomics, no problems. But then you start doing these perfect foresight impulse responses for productivity shock. And then you start adding some additional 0-time terms into, well, you motivate them somehow through the policy objective by that saying that you start in a very particular place. And I didn't quite understand why you need to do that. And if you can clarify.
I'm not sure I agree, and I'm not sure I understand which part of my talk you refer to. I have just
every time you were talking in this discussing this paper right now in the talk, you said, "Oh, I'm not going to talk about initial conditions."
But the date zero problem.
That's what I want to hear.
Sorry. So basically, what happens at date 0? So I'll tell you what happens at date 0, and I'll tell you also why I didn't want to mention it. Let me start by the second. So the paper is under revision, and the editor is telling us date 0 is irrelevant. It's a pathological feature of Ramsey problem that we have something at date 0 that is different from the past. So get rid of it. So we're working towards getting rid of it. So I don't want to bother you with something that will not appear later in the paper. But if you want me to tell you what happens at date 0 in this not yet modified version, what happens is that unless there is equal symmetric wealth at date 0, there will be a distribution of wealth at date 0, so which we take as to be the stationary, the ergodic distribution of wealth. Okay? If you do that, well, at date 0, there is an extra motive for redistributing wealth. So people have what is called in the literature an unhedged interest rate exposure. They have assets and liabilities that are given. Okay, so they cannot adjust them because they are given, and they are exposed to changes in the real interest rate. Okay, so Adrien Auclair has a very nice paper that is called the redistribution channel of monetary policy in AER, where it decomposes all the effect of monetary policy, and one of them is what he calls the unhedged interest rate channel. Okay, so at date 0, the real rate redistribute wealth in our economy. And monetary policy may want to play on that. Okay? That just occurs at date 0 is a bit of a pathology because it's only related to the fact that monetary policy is not committed at date 0. So the multiplier, the lagged value of the Lagrange multipliers are 0. Okay, fine. it's there, but I think I agree with the editor that it's pathology. It's interesting conceptually, but it's unlikely to be of policy relevance. Let's put it this way.
Thank you.
You're okay? You're convinced?
Yes. Okay, yeah,
cool,
it's better now. Thank you very much. Yeah.
So I think that probably we should come to the end. So we thank very much Edouard for this interesting talk. Now we're going to switch to the practice session, in which case, since we made all of you panelists, we will have to drop you from there, unless you want to remain, in which case, please tell us so in the Q&A, in the chat. And also stay tuned for the next webinar next Wednesday. Be careful about the time, may not be exactly the time, the same time, because of the time zone where the speaker is going to be, and it's going to be David Bakai from UCLA. So thank you very much, Edouard. Thank you very much, everyone, for coming, and stay tuned.
Thank you all for your questions and comments.